Welcome to your monthly investor update. I'm John Doolan and I'm the technical lead for the pot domain, which means I ensure that our developers know what they need to do and how to do it. If you've been watching our recent update, you'll know that we're following the government's guidance on social distancing and working remotely. So instead of filming the investor update at our headquarters, we're doing it here on Zoom. Today, I'm joined by James McManus, our Chief Investment Officer. Hi, James.
Hi, John.
Looking at my Nutmeg portfolio, it seems global stock markets had another good month in May. Does that mean financial markets are more stable now?
That's right, John. Financial markets did have another good month on the whole, and really are continuing to show resilience in the face of some significant near-term economic headwinds. In fact, in the month of May, we've continued to see volatility fall, and we've seen riskier asset classes perform, really buoyed by sentiment relating to the reopening of economies, but also the continued efforts of policymakers, central banks and governments globally to really limit that long-term damage on economies. So in terms of returns, global developed markets, equities returned around 4.9% for the month of May, for once not led by the US equity markets, but in fact by Japan and Europe, where markets returned between 6.7% and 4.9% respectively. UK large cap, meanwhile, continued to underperform their global peers in May, returning just 3.3%, whilst US large caps returned around 4.7% for the month. Emerging markets, again, another underperformer, continuing that trend of underperformance of their developed market peers, with performance of only around 0.6% for the month of May. And despite the economic challenges ahead, actually what we saw is that smaller companies as a whole performed well, with small caps in Europe, Japan and the US all outperforming their large cap peers for the month. Now, a similar trend was also observed in fixed income assets, the riskier assets offering the greater returns. Government bonds, a traditional safe haven, delivered very muted returns of only around 0.6% in the US and actually flat on the month in the UK. Whilst investment-grade corporate bonds continued to deliver gains, UK corporates offering investors a return of around 0.8% in May. But as I mentioned, it was really the riskier end of the fixed income spectrum that offered investors the greatest returns in May. And that was assets such as high-yield corporate bonds, which delivered returns of around 4.6%, and emerging market sovereign debt, which delivered returns of around 5.7% for the month.
There's been a lot of talk about negative interest rates here in the UK. What does that mean for investors?
Well, that's correct. So despite the Bank of England stating only a couple of weeks ago that it was not planning or contemplating negative interest rates, in the past 2 weeks, the Governor of the Bank of England, Andrew Bailey, has confirmed that the bank was actively reviewing the policy implications of negative interest rates. And when interest rates go negative, the result is that interest payments reverse their traditional course. And that is that lenders would have to pay the central bank in order to keep their reserves stored there, rather than receive interest on those reserves. And this also has a knock-on effect to savings and investment markets, with savers faced with the prospect of having to pay banks to save their cash, whilst bond investors will pay for the privilege of lending their capital to governments or corporations. Now, interest rates have been negative for some time in the Eurozone, and in fact in some other countries such as Switzerland and Japan. But the UK central bank, the Bank of England, has until now refused to contemplate this as a course of action. However, in recent weeks, the Bank of England also, or the UK Treasury in fact, sold 3.8 billion in negatively yielding 3-year government bonds. So that's the first time that the UK government bonds have been sold at a negative yield. And that's investors paying for the privilege of holding that debt should they hold it through to maturity. So will the Bank of England go negative on interest rates? Well, we know that interest rates have a lagged effect on the economy, and therefore policymakers will be in no rush to venture into negative rates territory should they decide or consider that is a sensible approach, particularly with the Brexit conclusion on the horizon in the next 7 months. That won't stop the market talking about negative rates, or at least taking existing bond yields negative if it believes that's the direction of the policy. However, at the current time, market expectations put only about a 20% chance of negative interest rates by the end of 2020.
Apart from the coronavirus crisis, what other big events are influencing in financial markets at the moment?
Well, we're certainly never short of political news stories at present, and whilst the Brexit negotiations continue to proceed under the radar, the familiar topic of global trade, and in particular the relationship between the superpowers of the US and China, is never far from headlines. This month, we saw China move to enforce security laws in Hong Kong. That's led to another step up in rhetoric between those partners. The move to enforce those security laws essentially violates a key part of the one country, two systems arrangement that's been in place since Hong Kong gained its independence from the UK. And that's a system that ensures that Hong Kong manages its affairs in all areas except national defense and foreign policy. In retaliation to this, the US has put in motion the process to remove the special trading status of Hong Kong. That's a key source of its competitiveness as a trading state, and something it's enjoyed since back in 1992, when the US passed a policy to treat the territory as a separate entity to China once the control of Hong Kong would be passed back to China from the UK 5 years later in 1997. So a very long-standing special status. And this means that Hong Kong could no longer be recognized as a unique custom territory. And that's a bit of a problem for Hong Kong. It's the world's third largest financial center. It's the world's eighth largest exporter and importer globally. And it really brings that country into the wider US and China trade spat, something it's avoided by virtue of its special status so far. But I think the key here is that both sides really have much to lose. 2/3 of China's foreign direct investment goes into the country via Hong Kong. But Hong Kong is the largest trade surplus contributor to the United States. And the US consulate themselves estimate that over 1,400 US firms have operations in Hong Kong, whilst the amount of US foreign direct investment in Hong Kong is total more than 82 billion as of 2017. So, this is really another significant escalation in the trade disagreement between the two nations. And whilst the special status hasn't been revoked yet, investors are beginning to fear that with a US election on the horizon, there's much room for increased escalation in the fallout between the two, particularly in the fallout post COVID-19. Closer to home, European nations have actually appeared to be making much greater progress on further support packages for the EU economy. The European Commission, built on some Franco and German plans that were announced a number of weeks ago, and announced last week a proposed 750 billion euro recovery fund worth around 5.7% of EU GDP over 4 years. And this is where the European Commission will raise funds externally in public markets and distribute these via grants to the most affected sectors and regions within the EU. This is really symbolic. It really raises the prospect of a response that's funded at a common level as part of the EU budgetary expenditure. And despite the fact that the funding would not be available actually until 2021, it's really a significant symbolic move. It would serve to counter a lot of the recent Euroscepticism within the EU. That said, however, of course, there is the familiar sticking point that we're likely to incur here, and that is that all 27 EU governments will need to agree on the plan for it to take effect. And there are, of course, several Northern European states who have been less favourable on the idea of debt funded at a common level in the past. So it still has some stages to go until we see that passed into legislation, but a really important symbolic step has been put forward in the past week.
So how did the Nutmeg fully managed portfolios perform during the month?
Given the strong performance we've seen in financial markets in May, all portfolios finished the month in positive territory. So returns in the fully managed portfolios range from around 0.9 in lower risk portfolios through to around 4.6 in the highest risk portfolios. So the strong performance on the month means that the typical Nutmeg medium risk fully managed portfolio has now recovered over 60% of the market losses that were incurred in February and March volatility.
Given everything that's happened lately, have you made any changes to the Nutmeg fully managed portfolios?
Well, we have made a number of strategic adjustments through the month in order to keep the portfolios in line with our medium-term investment view, but also to manage risk in the near term. And the first was really within our government bond exposure. And here we reduced our exposure to the longest maturity US government bonds. These are assets that have performed very well in the challenging market conditions that we've had so far year to date. And through to the end of April, they delivered performance of about 24% year to date. So very positive returns, but with so much fiscal expansion, so much government spending underway, that fiscal expansion really gaining significant momentum in the US, the fiscal risks for long maturity bonds have been rising. And so we've kept broadly the same position in portfolios in terms of duration, that's interest rate sensitivity, but we reduced our exposure to those longer dated securities that have a greater exposure to fiscal risk, and therefore, we've banked some of the performance that they've delivered so far this year. The second change in portfolios we made this month was another adjustment to portfolios to manage risk and to rebalance an asset that has been quite successful thus far. And that is that we trimmed our overweight in NASDAQ stocks. In those portfolios that own them, NASDAQ is the high growth index in the US. This position again has performed very well relatively since we increased our exposure to this asset back in March. Given the strong performance and recognizing the increased risk of crowding into these companies from other investors, we've rebalanced some of this position into a globally focused social responsible strategy. And we've also trimmed our US exposure in portfolios that don't hold NASDAQ directly. Again, just rebalancing a small portion of the position, given the performance of the US market relative to its global peers, and the concentration of investors in the US market. So we remain overweight the US, we remain overweight the technology sector, but really recognizing the risk reward dynamics are changing and taking some risk off the table into the latter part of the month. And then finally, we shifted some of our European exposure, in particular our EMU, European Monetary Union exposure, to a socially responsible focused approach in Europe. And this is a theme that we've been embedding for the medium term in our portfolio. So this is an approach that offers greater exposure to companies with stronger environmental, social and governance alignment. And it avoids exposure to those companies undertaking controversial activities, and offers a potentially lower carbon intensity, which in turn, of course, lowers the carbon intensity of the overall portfolio. So following these changes, the Nutmeg fully managed portfolios have on average around about a 15% exposure across the board to SRI theme within their respective equity allocations.
This month's customer question came to us during one of our recent webcasts. A viewer with the username AC asked, does Nutmeg have a view on the crypto market? And would you see that as a potential expansion area for Nutmeg's offering in the future?
Thanks for the question. I think for those who don't know much about cryptocurrencies, cryptocurrencies are a form of digital payment. They use a decentralized currency. They come in lots of different forms, each with their own unique characteristics, but some of the most popular are Bitcoin and Ethereum, and they're amongst the most widely known, and it may be that you've heard of those yourself. Because these assets are relatively new, they've been invented in the past 10 years, they lack the track record that many other investment assets have, and they're typically quite difficult for investors to analyze and value because of that. In fact, much of the perceived value of cryptocurrencies really relates to their potential future use rather than their current commercial use, and there is little in the way of fundamentals to analyze, and we don't truly understand how they might perform in different stages of the economic cycle, because quite simply they just haven't been around and haven't been through those different stages of the economic or business cycle as yet. They're also yet to receive regulatory support and to really be integrated into global payment systems in a way that legitimizes their use. So because of these reasons, and for further issues, also around fraud and custody and security, cryptocurrencies tend to be quite volatile. They tend to exhibit quite high volatility versus traditional investment asset classes such as equities or bonds. And so currently they're not regulated by the Financial Services Conduct Authority. And due to their relative lack of liquidity, the narrow access to the market that we have when we want to transact in them, and the typically high volatility that they embody, we don't consider them to be part of the suitable universe for Nutmeg portfolios at the current time. As the market matures, as we move towards greater transparency and greater accountability in that sector, we may revisit that decision to include them in our portfolios. But I think for the foreseeable future, for the reasons I've mentioned, we don't envisage including those in Nutmeg portfolios, and I don't envisage that many mainstream investors will see them as a component part of multi-asset portfolios in the near future.
Thanks, James.
Thanks, John.
And thank you for joining us. We know this is a very difficult time and understand that lots of our customers have questions. Feel free to contact us via email, social, or the comments section below, and we'll do our best to answer your queries. In the meantime, our best wishes to you, your families, friends, and colleagues. We look forward to seeing you again next month.